Ever wondered how the price of silver is really set? It's a fascinating story involving physical stockpiles and complex paper markets. A huge player in this game is JP Morgan. For years, they've been accumulating one of the largest private silver hoards in history. We're talking billions of ounces of physical silver stored away in vaults. So, how does this affect the price you pay? Well, the silver market isn't just about physical metal. There's also the paper silver market, like futures contracts on the COMEX exchange. JP Morgan is a major force here too. By strategically trading these paper contracts, they can influence the spot price of silver, sometimes keeping it lower than what physical demand might suggest. It's a classic case of Wall Street's power meeting a tangible asset. Is the silver price truly free, or is it heavily managed? That's the big question. Thanks for watching. Don't forget to like and subscribe for more insights. Have you ever wondered why the price of silver seems to move in strange ways, sometimes completely disconnected from what you'd expect based on supply and demand? Well, a big part of that story involves one of the world's largest banks, JP Morgan, and its massive hoard of physical silver. This isn't some conspiracy theory, it's a fascinating look into how modern financial markets work, and today we're going to unpack it. So, let's start with the big question. How much silver does JP Morgan actually have? The numbers are staggering. Through its vaults registered with the COMEX, the primary futures and options market for trading metals, JP Morgan holds an immense amount of physical silver. We're talking about hundreds of millions of ounces. To put that in perspective, that's more silver than the legendary Hunt brothers had when they tried to corner the market back in the 1980s. This stockpile didn't appear overnight. It's been built up strategically over the past decade, especially after the 2008 financial crisis. Why would a bank want to hold so much physical metal? It's not just sitting there collecting dust. This physical silver is the bedrock that supports their massive operations in the paper silver market. The paper market includes things like futures contracts, options, and exchange-traded funds, or ETFs. These are financial instruments that allow investors to bet on the price of silver without ever touching a single ounce of the actual metal. For every ounce of physical silver that exists, there are hundreds of ounces claimed on paper. This creates a huge amount of leverage, and it's where JP Morgan really flexes its muscles. Here's how it all connects. JP Morgan is a major player on the COMEX. They act as a market maker, which means they are on both sides of trades, providing liquidity. But they also have their own proprietary trading desk, making bets for the bank's own profit. With their enormous physical stockpile, they have the ultimate backstop. If a large number of traders suddenly decided they wanted to take physical delivery of their silver contracts, which rarely happens, but is a possibility, JP Morgan is one of the few entities that could actually deliver the metal. This ability gives them immense credibility and power in the market. Now, let's talk about price manipulation. This is a controversial topic, but there's substantial evidence to consider. For years, traders and analysts have accused large banks, including JP Morgan, of suppressing the price of precious metals through a technique called spoofing. This is where a trader places a large order to buy or sell with no intention of actually executing it. The fake order creates a false sense of supply or demand, tricking other market participants into trading at artificial prices. The spoofer then cancels their large order and profits from the price movement they just created. In fact, JP Morgan has faced serious legal consequences for this. In 2020, they paid a massive settlement of nearly $1 billion to resolve regulatory and criminal charges related to manipulating the precious metals and treasury markets for years. Former traders from their precious metals desk were convicted. So this isn't speculation, it's a documented practice. By using these tactics in the highly leveraged paper market, they can exert significant downward pressure on the price of silver. So why would they want to keep the price of silver low? There are a few theories. A lower silver price benefits them when they are in a short position, meaning they are betting that the price will go down. By suppressing the price, they can profit from these short positions and also accumulate more physical silver at a cheaper price. It's a cycle that feeds itself. They use their paper market power to push the price down, buy more physical silver at the lower price, which in turn increases their ability to control the paper market. This dynamic creates a major disconnect. The price you see on your screen, the spot price of silver, is largely determined by the trading of these paper contracts on the COMEX. It's not a true reflection of the physical supply and demand in the real world. Think about it. Industrial demand for silver is soaring, especially for solar panels and electric vehicles. Investment demand for physical coins and bars is also very strong. Logically, the price should be going up, right? But the paper market, with its massive leverage, and the influence of players like JP Morgan, can keep a lid on it. This is why many silver investors, often called silver stackers, focus on owning the physical metal itself. They believe that this paper game is unsustainable. Their thesis is that one day, confidence in the paper market will collapse, or run on the bank. Scenario could occur where so many contract holders demand physical delivery that the vaults, even JP Morgan's, simply can't fulfill all the orders. This is often called breaking the comics. If that were to happen, the paper price would become irrelevant and the price of physical silver would skyrocket to a level that reflects its true scarcity. What does this mean for the average person interested in silver? It means you need to understand the two different worlds, the world of physical silver and the world of paper silver. The price is set in the paper world, but the ultimate value lies in the physical. JP Morgan's strategy is a masterclass in playing both sides. They've used the paper market to their advantage while simultaneously building one of the largest private stockpiles of the physical metal in history. It's a powerful position to be in. They've essentially hedged themselves against the very system they help to control. If the paper market continues as is, they profit. If it collapses and physical prices surge, they win even bigger because they hold the real thing. It's a complex and often murky world, but understanding the role of giants like JP Morgan and the difference between physical and paper markets is key to making sense of the silver price. It's not just about mining output and industrial use, it's about financial engineering on a massive scale. The story of JP Morgan's silver hoard is a powerful reminder that in the world of finance, possession is more than 9/10 of the law. It's the ultimate source of power. Thanks for watching today. I hope this gave you a clearer picture of the forces at play in the silver market. If you found this interesting, please hit that like button and subscribe for more deep dives into the world of finance and precious metals. See you in the next video.